Now, up until this point, we've been pretending that you've been getting your money out of this minimum acceptable rate of return account that is of absolutely infinite size. Well, those kinds of accounts don't really exist, or for the most part, you're going to find that you're going to be collecting your funds that you use for investment from a couple of different sources, or alternately that your investment funds are strictly restricted either because you're a small business or not. And so what we're going to be doing now is discussing where you're getting these funds and what the structure of interest rates should look like and why they look that particular way. So let's start off with this diagram that we have right here, which has on the vertical axis, right around over there, just the interest rate of any kind of investments that you have. And on the horizontal axis, what we're looking at there is the scale of investment you're going to be making, or the scale that you're going to be borrowing from. And so what we're going to be doing is now pulling a trick out of the single period choice criteria, which is in order to find the optimal pace, the optimal amount that you should be investing in order to garner the largest net benefits to you, you should be ordering your expenses, the sources of your fund, from the cheapest to most expensive. And let's outline first what the cheapest source of funds for you is going to be, which also happens to be the largest source of funds. And that's going to be the funding that comes from retained earnings. And that's what you should think of this line as representing. This is your retained earnings. Now this is, in the world, the largest source of funds used for investment, the largest source of investment funds in the entire world. It's true in the United States, it's true in every single country that you go to. This is where most of the funds for expansion occur. These tend to be the least expensive source of funds, primarily because the people that are making decisions about how to use these funds are very tightly bound in with your business. They know exactly what projects they're working on. They know the strengths and the weaknesses of those projects because they understand the business, and they know you. They know your strengths and weaknesses, and they also know your sources of bias. So what I'm getting at is the people that are evaluating these projects are the people that, because they have so much knowledge, have a relatively smaller amount of uncertainty about what's going to happen with this investment project. And what you're going to find is that when you are more uncertain, your perception of risk is quite higher. Uncertainty is a way of saying you have some kind of risk there, although they aren't exactly synonymous. And if the risk is higher, if the uncertainty is higher, normally that person requires a higher rate of return. And what we're saying is that because these retained earning decisions are made by people within the organization with lots of knowledge, that they tend to have a lower risk evaluation and are willing to accept some slightly lower returns. So that's the first and largest source of investment funds that you're going to use. Now the second source of funds that I'm just going to go ahead and draw in right here are going to be bank loans. Now bank loans are again the second largest source that goes right after these retained earnings, and these are also relatively low risk because bankers will, after some time, develop a lot of information and knowledge about both your particular firm and your particular industry. You're going to find out that bankers actually do specialize in specific industries, and over time, after you've developed a reputation and a relationship with a banker, they are pretty aware of what it is that you're doing and can describe it oftentimes as well as you can. So these bank loans are the next largest source of funds. They also tend to be a little bit more expensive in terms of interest rates, and again, just because they have less knowledge and are a little bit more uncertain about the eventual results. Now not exactly the final, but the source of funds that comes afterwards is what you get out of the capital markets. And so what we're talking about here are issuance of bonds and issuance of stock that we're going to kind of put on the same upper level that we have right over here. Now, these are regarded as being, more uncertain, because if you're trying to go ahead and talk to an investor that's coming in from an outside about a project, they don't know all the individuals in your firm that are engaged in the project. They don't know the real hard specifics of your industry. They're coming in as an outsider, and they are going to have a lot of uncertainty. Classic response I can give you for this one is that some of you may actually own stock. Go ahead and pick a share of stock from one firm, anyone within your portfolio, and tell me where the nearest location is. Unless it's going to be something like Intel, unless it's going to be something like Columbia Sportswear, you're not going to know. because you all don't have that kind of intimate knowledge that an insider would. And so what I'm trying to express to you is that your funds for investments are going to come from three different sources. First, there's the retained earnings. The second one, and slightly more expensive funds, are going to be things like bank loans. And the third largest source is going to be the capital markets. And this means new issuance of stock and new issuance of bonds. We'll get to why the returns on those kinds of assets tend to be about the same in the next video.